So yeah, either way, you see gold in $5,000 to $10,000 range, and silver, who knows? Silver is so volatile that if gold has a big run because of a loss of confidence in the dollar or raging inflation or whatever, you would expect silver to go up even more. And for something that's relatively cheap right now, you can see some multiples of its current price. And it wouldn't surprise me at all to see $50 silver in the near term and $100 silver further out, and $200 silver in the final parabolic spasm in this whole cycle. Which means, the stackers have been very patient, and it could be that their patience is about to be rewarded.
This week's specials with Miles Franklin Precious Metal Investments. 10-ounce Wall Street Mint silver bars for only $3.15 per ounce over spot, and 2021 silver Philharmonics for only $3.75 over spot. Call us at 1-888-81-LIBERTY. That's 1-888-815-4237. Hey everyone, this is Elijah K. Johnson with Liberty and Finance. And back with us today is our good friend John Rubino from dollarcollapse.com, and also co-author with James Turk, The Money Bubble. John, thank you so much for joining us today.
Oh, sure thing, Elijah. And, congratulations on the family business that you guys are building there. It's fun to see you all doing stuff like this.
Definitely. It's pretty crazy recently. We've had a couple of the biggest months for, selling precious metals, which I guess kind of points to how a lot of people are concerned about what is happening in the economy and what is happening with inflation. We see the Fed originally was talking about transitory inflation. Now they're kind of concerned about that, doubting that is transitory, and they might be tapering next month. And you've been reporting on inflation a lot recently. You've been stating how even like technology, right? Like solar panels, for example, the prices of those are rising when normally the price of technology should be falling. And also you're saying that even, inflation is bad in the US, but it's even worse in other countries. So can you take us kind of down that path of enlightening us about what is happening with inflation, has been happening with inflation recently?
Well, yeah, inflation is really a multifaceted concept because it's basically the destruction of the currencies around the world. And since that's, it's everybody's money, so it hits everybody in different ways, but it affects all of us. And what's happening now is that all the money that we've been creating out of thin air and dumping into the system is finally starting to cause broad-based inflation. We've been in a very inflationary world for the past couple of decades, but the inflation has been narrowly focused on stocks, bonds, and real estate. In other words, financial asset prices have been going through the roof, but the Fed and the other central banks of the world, they don't count that as inflation. They consider that to be quote unquote assets and not part of the cost of living, which is crazy because, if you're trying to invest and save for your future, then the cost of investing and saving, those are parts of your cost of living, right? But anyhow, they lie about inflation that way and have managed to fool people for a lot of years into thinking there was no inflation. Well, now inflation is starting to spread. Commodities are up, and that's causing the cost of food and energy to go through the roof. And so normal people who don't normally obsess about financial asset prices or economic theory or anything are starting to realize that we're in an inflationary environment. So this idea that it was temporary and that things would go back to quote unquote normal pretty soon is starting to fade and to be replaced by the idea that this is the new normal. This is our world. Prices are going to go up. And they're going to continue to do so for a long time. And that's starting to change people's behavior. You're seeing stories of hoarding and of course, people demanding much higher wages now because whatever raise they might have gotten in the last few years is totally inadequate to cover the decline in their, the rise in their cost of living, therefore the decline in their real wages. So the world is changing fundamentally. And that kind of changed mindset is starting to filter over into the investment markets. And that's where the real action happens pretty soon, I think, where, when people start acting on the assumption that the dollar is going to decline at an accelerating rate, for as far as the eye can see, then everything changes financially. And it feels like we're entering a period like that. So, hold on to your hat. This is going to be a very different world going forward than the one we've lived in for the past couple of decades.
And why do you think other countries are experiencing higher inflation than the US?
Well, a lot of other countries, not necessarily that they're experiencing higher inflation, as that it's a way bigger deal for them. For instance, a developing country like Brazil, let's say, and there are 80 other countries in the same boat. Their people spend a much bigger part of their incomes on the basics of life. In other words, food, shelter, and energy. So in the U.S., gas prices can go up and rents can go up, and we basically we complain about it, we're inconvenienced by it, but we get through it. People in a developing country might not survive it because they can't afford food, or they can't afford shelter, or they can't afford to drive to work because they can't put gas in their car. And so that's a much bigger deal for them, both personally and politically, because when people start to starve, they demand help from the government and they hit the streets to get it. So you're liable to see civil unrest flowing from what happens in the commodity markets, for instance, in Brazil or the Middle East or a lot of the rest of Latin America or Asia. Whereas, that's probably not the case here. We're going to complain and we'll suffer in our own rich country way, but we're not going to overthrow the government. And, the same can't be said of Chile or a big part of the Middle East, and so that's a much bigger deal in the rest of the world than it is here. And it eventually comes back to bite us because the big money center banks have lent a lot of money to emerging countries. Emerging countries have borrowed a lot of dollars, in other words. And when they can't pay their dollar debts back, that's a big problem for our banks. And that actually, not to get too deep into the historical weeds, but that's one of the things that started the current era was a lot of developing countries back in the 1990s started to go bankrupt. They couldn't pay their dollar-denominated debt. And the Fed under Alan Greenspan had a choice of letting those banks suffer the consequences of their bad behavior or bailing them out. And he chose to bail them out, which basically set the tone for monetary policy for the next, 1990s to today. So the next 3 decades and change, which is that if you get into trouble, we'll bail you out. Therefore, take any risk you want to take and collect the fees in the meantime, get very rich. And if it doesn't work out for you at the end, we've got your back. Don't worry. And so the banking industry, the global financial industry, really just kind of went crazy after that. And we ended up with the world that we have today, which is massively indebted, massively over-leveraged, and always on the verge of some kind of huge crisis. So anyhow, I veered a little bit off of the emerging markets thing, but that is a big deal. If the countries, and the other thing about emerging markets is that they supply us a lot of our commodities, which we need to maintain first world lifestyles. So let them descend into chaos, and supply chains will be even more kinkier than they are now. And it'll be less likely that we'll ever get back to normal in terms of inflation, in terms of prices, in terms of availability. So it's a big deal. Pay attention to what happens in Brazil and Chile and places like that, because as they go, so will we go at some point in the future.
And what do you think are some of the root causes of, we've talked about inflation, but you've also mentioned the supply chain issues and just people, not being able, the companies not being able to get enough workers. What do you think is the root cause of that?
I don't know about the labor thing. That's a bit of a surprise, because you would think that everybody who was partially impoverished by the pandemic lockdowns, and that's, several hundred million people, several tens of millions of people in the US and billions of people around the world, you would think they would be desperate to get back to work, and pretty much on any terms, because they lost so much to the lockdowns. But it's not the case. A lot of people just aren't coming back. And a lot of the people that are coming back are finding that they have a choice of jobs, and they're demanding higher wages where they are, or they're out and out leaving for someplace else. The numbers of people who are quitting their jobs, it's really high right now. which means they're not just quitting work, they're switching to higher paying jobs. And this is really important from the inflation story angle, because wages are something that the Fed does look at and consider to be inflation. You know, stock prices can go up to infinity, and the Fed still won't admit that there's inflation. But if wages start going up by 7% a year, the Fed will panic. And we're kind of in that stage of the process right now where they're seeing this happen. It's what they define as inflation. And that's leading them to want to tighten sooner rather than later. So, you know, and then we get to the whole, can they even ever tighten? And I think the answer to that is no. You know, you can't raise interest rates in this kind of environment. You can taper a little bit before things turn crazy, but you can't flat out raise interest rates. And the big psychological change in this world will happen when people realize that it's not possible for the Federal Reserve to ever tighten monetary policy again. And therefore, they have no tools left to control inflation. And if inflation starts to arc upward from here, you'll get absolute panic in the financial markets, because there will be no solution to this problem, which is causing all kinds of trouble. And you know, that could be a next year thing, because the one very reasonable scenario is that the Fed tightens or tries to tighten. We get another taper tantrum where stocks tank and the bond markets flake out, and you just generally see financial turmoil out there. Then the Fed backs off, as it always does, and says, oh, did I say I was going to tighten? No, I meant ease. I'm going to cut interest rates to negative levels, you know, and does something like that. And then people realize that that's it. You know, they will never be able to actually control the financial markets again. You know, it's very good for gold. I don't think we should be gloating about this because it's bad for so many other people. But for people who are in the precious metals sector, the gold bugs of the world, the silver stackers, the guys who own a lot of mining stocks, I'm describing a world in which they make a lot of money, because so much new capital will pour into safe haven assets once they realize that the Fed can't stop inflation. So everybody's going to be looking for things that the Fed can't inflate away. And that means farmland and oil wells and really well-chosen rental houses and gold and silver. And it really does feel like we're not far from that kind of a situation where we start to see that psychological change take place in the market, which then manifests as capital flows into safe haven assets. And that could be a 2022 story.
And it's interesting because this flight to safety, and especially into gold, you've described before as it's not necessarily directly because of the inflation, but because of a lack of faith in government. So why do you think it's more of a lack of faith in government rather than inflation that will drive this move?
Well, that's a thesis from Martin Armstrong, who has been right about the direction of, for instance, stocks for a lot of years. When it didn't seem all that reasonable that he would be right, he has been right. And his take is that, gold will go up as all this plays out, but it won't be because of inflation. It'll be because we lose faith in the governments of the world, and we'll start looking for a kind of money that isn't run by these idiots in charge of the Fed and Congress. And, I kind of think we end up in the same place, whether you look at gold as an inflation hedge or as a hedge against government mismanagement. But I think it's important to understand that plays a factor because of what's going on right now. We're seeing the U.S. government behave in ways that is costing it a lot of credibility. Start with the Afghanistan withdrawal, which was really reminiscent of Vietnam, with vehicles taking off and people holding on to it and falling off and everything, and us leaving huge amounts of military hardware and a lot of America's citizens behind. And it's not inspiring confidence in a lot of people. And then, the way the pandemic is being handled, I don't want to get you in trouble on YouTube, but let me just say that a lot of people are frustrated by what they see as dishonesty and conflicts of interest in the handling of the pandemic. And at the same time, you've got Congress people and Fed chairmen insider trading based on their actions. They're out there buying and selling stocks that they have some power to control. So add it all up, and Biden's approval ratings are way down, and there's just a general sense that we're not a well-run country. And because our government actually manages the currency too, when they're proved to be incompetent in other aspects of the work that they're doing, that bleeds over into the money. You look at them and say, do I really want the currency that's managed by those people? And you can say, you conclude, no, you don't. And you start looking around for other forms of money that might be less volatile and less open to their manipulation and mismanagement. So yeah, either way, you see gold in $5,000 to $10,000 range, rather than the 2,000-ish that we're seeing right now. And silver, who knows? Silver is so volatile that if gold has a big run because of a loss of confidence in the dollar or raging inflation or whatever, you would expect silver to go up even more. And for something that's relatively cheap right now, you can see some multiples of its current price. And it wouldn't surprise me at all to see $50 silver in the near term and $100 silver further out, and $200 silver in the final parabolic spasm in this whole cycle. Which means, the stackers have been very patient, and it could be that their patience is about to be rewarded.
I think that's very interesting because, some people have argued, if you look at the precious metals for the last 10 years, it's pretty much flat, right? It went down and back up. But the key thing is, as you mentioned, that patience, because we really don't know when we're going to see this crisis. But at the end of the day, holding precious metals is like holding insurance, right? You don't want to have to use it. I think that we just interviewed Bob Moriarty, and he said the exact thing. It's like insurance. You don't want it to necessarily go up, right? You're holding it to have something there that you can turn to if we do see a crisis.
Yeah. And how does insurance works psychologically, right? Nobody wants to buy it in good times, but then as soon as it might be needed, everybody wants to buy it. But by that time, the price has changed kind of dramatically, So insurance is something that, if you're wise, you buy in the expectation or the hope of never having to use it. And if we end up in a world where we need to use gold and silver to buy groceries or whatever, that's not going to be a fun world for most people. So yes, gold and silver will allow you to continue to transact and continue to be able to get the basics of life. But beyond that, most of the rest of your life probably won't be very happy. It'll just be a messy, scary world, and you'll be glad you have gold and silver, but you don't hope that you're going to end up in a place where you need it, because that world won't be very pleasant. But, I kind of tend to think we're headed that way regardless of what we hope. We're just borrowing so much money that the consequence of that has to be such a period of chaos that for most people, it's going to feel like a kind of dark age, depression-ish. It won't be necessarily the same in all the particulars as the Great Depression, but it's liable to feel that way for a lot of people. But in the Great Depression, there were people who made a ton of money by betting against stocks and by otherwise protecting themselves. And the same will be true this time around. The people who choose the right forms of insurance are the ones who will come through this in the best shape and be best able to help their friends and families. So that's what we should be aiming for. We can't fix the world. We can't make this world or the world of 5 or 10 years from now this sunny, happy place, because that's unlikely given the mistakes we're making now. But we can protect ourselves and our families in ways that allow them to get through what's coming relatively unscathed. And, that's a pretty good goal. And if we can all end up doing that, we'll be very glad we took the time to try to understand the world now.
No, we've talked before on this show with you about, what could be the trigger for this all to collapse, right? Because so many things, it seems like, are just at all-time highs, right? And it's like a lot of the problems of 2008 were just papered over. And it's like, well, it would just take one event to kind of have the whole system collapse. Now, your perspective on the possibility of the real estate issues right now in China being that catalyst.
Well, yeah, there's always been this search for the catalyst. What's the thing that blows up first? What's the first domino to fall that knocks down the other dominoes? There are a lot of possibilities out there. I mentioned emerging market dollar-denominated debt. That could be one where they start defaulting on their, several $1 trillion worth of dollar debt. And Evergrande in China could be another thing. They chose to build their economy around real estate. Something like 72% of Chinese household assets are tied up in the real estate market versus like 30 for the US, which is already a kind of a real estate centric country. So if their real estate market starts to flake out, that's most of the country that's at risk there. And what's happening now is a lot of their big real estate companies over leveraged themselves dramatically. They became almost Ponzi schemes. And now a big one is blowing up. The others are suffering because of that. It's very hard to borrow money right now if you're a Chinese real estate developer. And it's not clear how a lot of them survive if they can't bring in new capital because they can't service their old debts without bringing in new money. So China is very possibly the epicenter of the next collapse. We don't know for sure that it will be, but it could be. And we'll have to see how they respond to this because, it's not clear you can bail out a sector that represents 72% of household assets. That's a really big part of GDP there. And the Chinese government so far hasn't really been anxious to bail out its real estate developers, but they might have to at some point. And then the question is what becomes of their currency if they're going to bail out that big a part of the economy with newly created yuan. I don't know. It could happen. That could be the thing that blows everything up, or it could be something completely out of left field. You can't know until really after the fact what it is that is going to be the catalyst for the next big crisis. But the important thing to understand is that we've created the conditions for the next big one to come along. So something will pop that bubble. We don't know what it is right now, but there are some really stellar candidates out there. And I suspect it probably be one of them, though not necessarily.
And help our viewers understand this. If this is going to cause an issue with the Chinese currency, why would that be an issue for the United States?
Well, China is the second biggest economy in the world, or the very biggest, depending on the measure that you use. So a crisis there means a crisis for the rest of the world because that's such a big part of the global economy. They're also a huge source of necessary manufactured things for the U.S. We basically exported our manufacturing base to China. So if their supply chains start to tangle up even more than they are now, then that means there's a lot of stuff that we can't get that we need. For instance, microchips is a good example. The auto industry is kind of hamstrung right now because there's a shortage of just a couple of specific kinds of microchips. China produces a lot of electronics, so they could play a part by having a crisis domestically in shortages that slow down or screw up otherwise the economies in other countries. And they hold a huge number of U.S. treasuries. Like if they have to sell their treasuries in order to prop up their currency, then what does that do to the value of treasury bonds in the rest of the world? Does that cause treasury yields to spike? Or does it crash the value of the dollar because our treasury bonds are being dumped worldwide? We just don't know. But all of those things are possible. And, we have to see how it plays out. But it's doubtless that a big crisis in China is a big problem for us. There's no way to get around that. And the particulars, who knows? But the eventual effect of some serious thing happening in China is a serious thing happening in the U.S. and Europe and Japan and the rest of the world.
All right. Well, John Rubino, it'll be definitely interesting to continue to have you on and help us track all of this. Before we let you go, did you want to share with the viewers any last thoughts you had and where our viewers can find you online?
Yeah, all this gloom and doom stuff will drive you crazy if you focus on it too much. So remember that this is an investment thesis. We're talking about bad things happening in the world, which will affect the financial markets in ways that can be exploited or at least protected against. So remember that, it's possible by playing this correctly. You can make a lot of money for yourself and your family. Focus on that because that's at least a hopeful idea. and then don't let the dark clouds and the potential trouble that is out there in the world make you just depress you in ways that I hear so much from a lot of people. And a lot of people are very depressed by what's going on out there, and they're very scared, and they don't know how to deal with it. Well, let's find ways to deal with it, and let's focus on the good things that will flow from dealing with it correctly. Now, as for where I am online, I run dollarcollapse.com, and that's a website that's updated continuously to cover the stuff that we talked about. And you can click on the Join Our Email List button, put your email list in, or put your email address in there, and then I'll just send you whatever I write for free.
All right. Well, John, once again, thank you so much for your time, and God bless.
Thanks, Elijah.
This is Dunnigan Kaiser, founder of Liberty and Finance. I'm now a licensed gold and silver broker for Miles Franklin. Call me directly for the physical gold and silver that you need at the best price with personalized private service from one of the oldest and best companies in the business. 31 years strong, A+ rated by the Better Business Bureau, 0 complaints, licensed and bonded for physical delivery, vault storage, or precious metals IRAs. Excellent prices, privacy, and confidentiality. Pay by check, money order, ACH, bank wire, or Bitcoin. Satisfaction guaranteed. For fastest service, just call 1-888-81-LIBERTY. That's 888-81-LIBERTY. And either I or one of my sons and fellow brokers will call you back as soon as we can and understand your needs.